Interest rate parity theory or interest rate parity condition, in here we are discussing about the interest rate changes and its arbitrage process and its law of one price and coming to the interest exchange rate determination, right? So now we know that the spot and forward rates are closely linked to each other based on interest rate. Now, I believe you remember this point, right? The exchange for spot rate and forward rate. Why it is linked with the interest rate? Because we identify when calculating forward rate, we have to make the adjustment into the spot rate based on the interest rate differences. I believe you remember that point. If you don't remember, please go to the exchange rate markets and find out this forward rate calculation. Okay, so that's the meaning. The movement of the funds between two currencies to take advantage of interest rate differential is a major determinant of spread between forward and spot rate. Right. Now, under the discussion of how exchange rates are determined based on interest rate differences, in here we are dealing with interest arbitrage. Right? Earlier for the inflation, we discussing with commodity arbitrage. If you remember, right? So different prices for different same commodity. Now in here we are dealing with the interest rate differences for the financial assets, right? Maybe treasury bills, maybe treasury bonds, right? Or some other financial assets or financial denominators, right? We are trying to find out how interest rate differentials are going to have this exchange rate determinations. Okay, so interest rate parity theory, it explained that the currency of the country which is low interest rate should be at a forward premium in terms of currency of the country with a higher rate, with a higher interest rate, right? So that means if a country have a low interest rate, okay, that country's currency should be at forward premium. That country's forward rate should be at the forward premium comparative to the country where interest rate is high. Right. Now, let's see the example. Now, assuming that we take the same example, USA and Sri Lanka. Okay. Now, the interest rate is Sri Lanka, assuming that it is, let's see, let me have to this pen. Okay. Now, in Sri Lanka, assuming that interest rate is 10%. Okay. And in USA, we normally know that in Sri Lanka having the highest interest rate. Now, USA, we say interest rate is 4%. Now, which one having the highest interest rate? Sri Lanka has the highest interest rate. Okay. Now, if Sri Lanka has the highest interest rate, according to the interest rate parity theory, right? We will discuss this process later. Now, for the moment, try to understand this. If Sri Lanka having the highest interest rate, then Sri Lankan rupee need to be at forward discount comparative to the US dollar. Right now, in this description, it says low interest rate, right? Now, my example, I'm taking highest interest rate, right? Now, Sri Lankan interest rate is higher than comparative to the US interest rate. If it is so, in order to maintain this interest rate parity condition, like what we call purchasing power parity condition, right? So, Sri Lankan rupee need to be set at forward discount in terms of the US dollar. ඒ කියන්නේ ශ්‍රී ලංකා රුපියල ඩොලර් එකකට සාපේක්ෂව forward discount එක calculate වෙන්න ඕනේ ශ්‍රී ලංකාවේ interest rate එක US interest rate එකට වඩා වැඩි නම්. Okay, or in the other hand, if Sri Lankan rupee interest rate is lower than US interest rate, right? In that sense, Sri Lankan rupee has to be set at forward premium in terms of US dollar, right? So within bracket, you can see what I'm discussing earlier, right? So interest parity or interest rate parity ensure that the return on the foreign investment will be just equal the domestic interest rate on investment of differential risk, thereby eliminate the possibility of having money machine, that means interest arbitrage. So actually what we call interest arbitrage means we borrow money at low interest rate market, right? We borrow money at low interest rate market and try to invest them into high interest rate market, right? So interest rate parity condition try to eliminate that arbitrage process. Actually, that is happening at the end of the arbitrage process. What is happening? If country has high interest rate comparative to the other country, so that country which are having high interest rate should be at forward premium, that country's currency should be at forward premium comparative with the country with low interest rate. Okay, so sorry, forward discount. If country has a high interest rate, that country's currency should have a forward discount in terms of the country which are having low interest rate. Okay, right. Let's see the example. Then you will get more understanding about this. Right. Now this is the example. The interest rate on 3 months treasury bill, now you can see in New York market, that means USA market, it is 10%, and in London market, it is 14%. Now, the interest rate normally given as per annum interest rate. Now, normally we are not pronouncing the interest rate per 3 months, something like that. If you are having per annum, it is your duty to convert it as a 3-month interest rate, 6-month interest rates, so on. Okay, so now we are getting the 3 months treasury bill interest rate as per annum. Now, by looking at the figures we are given, we can see that London market interest rate is higher than New York market interest rate. Right? Now, as a layman, what investor can do? Investor can earn more interest payment if he invests into the London market. Right? So they can earn more opportunity or more gain if that person invests into the London market. Now, actually, what investor can do is in the New York market, they can borrow money at New York market at a lower interest rate and invest into the London market. Right? So that's what normally people are doing. Right? When after 3 months is getting, when the maturity of the London treasury bills when you are getting the maturity of the London treasury bill, you can set off your loan with these payments, with its gain. Right? Okay, so US investor can earn 1% extra interest for 3 months London treasury bill. This is for 1 year. No? So if you convert it in 3 months, so you can see 1% difference in London market comparative to the New York market, right? So exchanging dollar to pound at the currency spot rate and purchase treasury bills in London market. So what investor can do is, right? So he can borrow money from New York market at a low interest rate and convert that into the pound, right? Then invest it into the London market at higher interest rate, right? So after getting 3 months, US investor want to reconvert its pound into dollar, and then he can set off its dollar terms loan where he gets from the New York market at 10% interest rate. Right? So difference between what he gained from London market and what he offset with the bank, he received as a net gain from the investment. Right? ඒ කියන්නේ බැංකුවෙන් ගත්ත මෙතන මැචුරිටි එකක් එක්ක ට්‍රෙෂරි බිල් හම්බුනාට පස්සේ ඒන සම්පූර්ණ මුදලෙන් ලෝන් එකේ amount එක පියවුවට පස්සේ යාට යම් කිසි මුදලක් ඉතුරු වෙනවා නම් ඒකට තමයි අපි කියන්නේ net gain එක කියලා. Right? Normally, investors are not putting their own money for the investment. They normally borrow it and invest it into some other place. Then, so now we can see some process between these things happening, right? Now in the New York market it is 10% and London market it is 14%. What actually investor can do is he just try to borrow fund from New York market and invest into the London market, right? Now let's talk with the timeline in here. Right, now let's see, this is today. Right, now we are in here today. Now this is our 3 months. Okay, now today what the investor can do is, by looking at this different interest rate, he borrow money from New York market. Right, now we borrow something from New York market. Right, then I just write it in here, borrow dollars. Sorry, my handwriting. You borrow dollars from New York market, right? And then you are converting that dollar into the pound, right? At the spot rate. Now you are doing this into the spot market, right? You borrow it today and you convert it into the pound and invest into the treasury bill market. Right? This is all are happening today. This whole process are happening today. You convert it into pound and you invest it into the London market. Right? Now there are time gap, right? Now 3 months, you have to wait until 3 months to get in the maturity of your treasury bill investment. මාස 3ක් ඉන්න ඕනේ treasury bill ටික mature වෙන්න. Right? And then you know at the end of the 3 months what is the exact amount you are getting for your investment. Right? Now you invest in terms of pound. Right? When the 3 months is over, you know your principal interest, your principal amount plus interest you will receive at the end of 3 months. In which currency you are receiving? You are receiving in terms of pound. Okay, you are receiving in terms of pound. Then if you are a good trader, right? If you are a good trader and you don't try to convert that pound at the same time of the spot market when the 3 months is over. So මේ pound එක මාස 3ක් ගියාට පස්සේ හම්බෙන pound ටික ඒ වෙලේ තියෙන spot rate එකට ඔයා මාරු කරන්න ඉන්නේ නැහැ. Why? Because investors are risk averse, right? Because we don't know what will happen to the exchange rate rates after the end of 3 months. Then what is the best option you can do? You are going for the forward contract. You know what is that forward contract right now, right? So today you are going to agree to sell your pound, which you are going to have at the end of the 3 months, right? Predetermined rate, which we decide today. So that is the rate we call forward rate. I believe you remember, right? Then you try to make the forward contract today, right? At the rate of, we call forward rate. Okay, forward rate. So that forward rate, you know how to calculate. How to calculate? So forward rate is normally calculating by looking at the interest rate differences between two countries and make the adjustment to the spot rate. Okay, now you know London market interest rate is high. Now you know London market interest rate is high comparative to the USA dollar, USA market, right? Okay. Now if you look at your forward rate calculation, if you go back to your third session and find out the forward rate calculation, we are making adjustment based on the domestic currency interest rate and foreign currency interest rate. Since now we are dealing with the pound forward contract, we are dealing with pound forward contract. Now London become your domestic market, right? London become the domestic market, right? So then, since the London rate or the UK interest rate is higher than comparative to the US interest rate, normally UK pound is at forward discount. Normally, UK pound is at forward discount. Why? Because UK interest rate is higher than USA interest rate. Therefore, UK pound need to be set at forward discount in terms of US dollar. That's what we discussed in our previous slide, right? So if you try to sell it to a pound at the end of 3 months, and if you try to make that forward selling contract, remember you will get dollar is at a forward discount rate, right? So assuming that if dollar is at a 3 months forward discount of 1% per annum, that means ඒ වෙනකොට forward pound එක forward discount එකකට යන්නේ අවුරුද්දට 100ට එකක rate එකට. That means for 3 months it is 0.25% per month, 3 months, right? Then USD investor will only lose this 0.25% of having forward exchange discount, forward rate discount, right? For the interest rate, he received 1% addition as a result of investment in London market rather than going with the New York market, right? The difference for the 3 months is 1%. But the pound is at forward discount of 1% per annum. That means for 3 months, it is 0.25%. Then what is your net gain? Your net gain means the interest rate differential minus by forward discount of pound. 1 minus 0.25 mean at the end of the 3 months, you will receive 0.75 net gain for your investment in London 3 months treasury bills, right? So this is happening as interest arbitrage. This is happening as interest arbitrage. Now you can see the process of interest arbitrage. We are still not dealing with interest parity, right? Try to understand, student. We just only discuss still interest arbitrage, right? What is that arbitrage? You borrow from the New York market, invest into the London market. Why? Borrowing rate is low in New York market, investment rate is high in London market, right? Since you are getting your maturity period after 3 months, you know at the 3 months how much you received for your treasury bill of London market, right? Then for the good trader or risk averse trader, you are making the sell forward contract, right? At the end of the 3 months, you said your bank, I am going to sell this much of pound for your bank at the rate of this. That is we call forward rate, right? Normally, when we are having high interest rate currency, that currency normally set at forward discount rate. Okay, so as a result of this, now you can see that when you are dealing with this forward rate, pound is at a 0.25% forward discount rate, right? Even though we are having the pound is at a forward discount 0.25, that investor still getting net investment gain as 0.75%, right? That means we are still having interest arbitrage, right? We are still having interest arbitrage. Okay, so keep that thing in mind, the interest arbitrage process. Let's move into our discussion again. Okay, now actually what happened in London market and New York market? The fund transfer from New York to London market rises interest rate in New York market. Now why? People are trying to borrow from New York market, therefore demand for loans increase in New York market. Okay, that means the interest rate in New York market now getting increase. Okay, on the other hand, what happened to the London market? People try to invest into the London treasury bill. Then supply of invest increase in London market. As a result of that, it pressures to reduce the London market interest rate. Okay, now I'm telling the scenario of this interest arbitrage, right? Actually what in here, the London market interest rate is high comparative to New York market. What investor can do is he can borrow funds from New York market and invest it into the London market, right? If this process continue, what happened into the New York market? People have more demand for borrowing in New York market. Why? Interest rate is low. As a result of that, interest rate getting high in New York market. Then people try to invest into the London market denominators, then supply of fund increase in London market. So as a result of increasing in the fund supply in London market, then the London market interest rate getting decrease. Now you can see the positive difference between this London and New York market interest rate now getting regularly diminished or getting reduced. Okay. Now in the second phase, right? Now people try to purchase pound in spot market. Why? In order to invest into the London treasury bill, they need to buy pound, right? So at the spot market, try to buy pound by selling dollars, right? So in the spot market, the interest rate going high, right? On the other hand, the people are trying to sell pound in the forward market, right? We know that they are trying to make the forward contract after when the treasury bills are getting matured. Then at the forward market, selling pounds getting increased. Then it costs to reduce forward rate in forward market, right? That's why we can see forward discount on the pound, right? The positive difference between spot and forward. Now it's getting increases. Right now you can see the scenario why pound is at a forward discount. Right, initially I explained in here because of having the interest rate differences, the pound should be forward discount, should be at forward discount. Now you need to know why it has forward discount because of this point. Right, so that's why we call it is having interest arbitrage parity. Okay, now you can see the interest difference in favor of New York now getting decreased, right? So that amount of interest, if an interest difference decrease, reflect through this forward discount on pound, right? On the one hand, the interest difference on New York getting decreased. On the other hand, the increase of the forward discount on pound. Then you can see now this gain is happening is here because why? Now we are having 1% of interest difference in favor of London, and we are having forward discount of pound 0.25. Actually, this is our loss. This is our loss, right? This is our gain. We are having 1% gain, a company with 0.25 loss, but your net gain is what? 0.75. So still people are trying to dealing with interest arbitrage. But if this process continue, this 1% gain decrease and this forward discount getting increased, then what will happen to your net gain? So this net gain now become 0, right? So if this interest arbitrage continues, I come into the covered interest arbitrage point later, okay? If this interest arbitrage continues, the positive interest differential getting decreased, that means this first point, the forward premium on pound become now forward discount, actually pound getting forward discount more, the second point, then your gains are completely wiped out, okay? Now, why we call this interest arbitrage as covered interest arbitrage? You can see the word in here in your first slide. In our initial discussion in interest rate parity. Why we call it as a covered? Because we covered the risk of exchange rate changes happening after 3 months by entering into the forward contract for selling pound. ඇයි අපි එකට covered interest arbitrage කියන්නේ? ඒකට අපි covered interest arbitrage කියන්නේ අපි contract එකකට යනවා forward contract එකකට මාස 3ක් අවසානයේ අපිට ලැබෙන pound amount එක sell කරන්න. That means we are minimizing our risk of foreign exchange rates changes. Right? That's why we call covered interest arbitrage. Nothing else. Okay, that is covered interest arbitrage. Okay, now my point is people are dealing with the interest arbitrage because of having these interest rate differences, right? When the process going on, that positive interest differences getting diminished. On the other hand, the forward discount getting increases where in highest interest rate country comparative to the lower interest rate country. Then the positive interest rate differential diminish, then that pound become forward discount more, then your net gain getting wiped out. Okay, now you can easily see this point on this paragraph, sorry, on this graph, right? Now you have two axes, right? Now this is your covered interest arbitrage parity. Like our purchasing power parity, now you can see there is no gain or loss from this point. Either you are going with the interest investment in other country or investment in your country. Okay, right. Now, let's see one point in here. I just explain it and come into the graph again. Now, refer the point A. Before going to point A, these are the two extremes. Now, you can see the interest difference with respect to domestic currency country and the foreign country. Now, you can see the first denote for the domestic country interest rate and the second one for the foreign country interest rate. Now, the positive signs indicate in here that the domestic country interest rate is higher than foreign country interest rate. So negative interest rate indicate that the domestic country interest rate is lower than foreign country interest rate. Now your horizontal axis representing in here the foreign currency at forward premium and in here the foreign currency at forward discount. But on the other hand, you can see domestic currency at forward discount, domestic currency at forward premium. Okay, so looking at the point A, now you can see the negative interest rate differential is 2% per year in favor of foreign country investment. Look at in here, point A is here, right? Now you can see at the point A, you can see it -2 interest rate difference. That means foreign country interest rate is higher than domestic country interest rate. That's why we are getting negative value. So when we are coming to this point, -1 indicate forward discount. That means foreign currency at forward discount. Why foreign currency at forward discount? Now you know, because its interest rate is high, right? Then the foreign currency is at forward discount at 1%. There is a covered interest arbitrage margin of 1% per year leading to capital outflow. What do you mean by capital outflow? Still, people see that we are getting the gain from 2% interest difference in favor of foreign country, and we are still having loss of 1% forward discount. Right? If you remember our example, 1% interest difference, but we are having only loss of 0.25 interest loss. Sorry, forward discount loss. But still, we are having a net gain of 0.75%. Same scenario in here. Interest rate different, we are having 2% gain, right? If we are investing foreign investment, we are still having more than 2% investment interest rate difference favor. But since forward rate for foreign currency at a forward discount, we are losing 1% from that gain. Then what is the net gain? We are still receiving 1% gain if we are invested in foreign country investment. That's why we call it as a CIA covered interest arbitrage outflow. That means we try to invest in foreign country. So you can see this highlighted color triangle. Highlighted color triangle representing the forward premium with this foreign interest rate favor point. Right? So this triangle having the opportunity for capital outflow investment gain. මේ ඔයගලන්ට පේනවා මේ highlighted කරපු triangle එකේ එහෙම නැත්නම් ash color triangle එකේ ඕනම point එකක ඔයගලන්ට ඕනම තැනකින් බලන්න පුළුවන් capital outflow එහෙම නැත්නම් අපි පිටරට ආයෝජනය කරොත් අපිට තියෙන වාසිය වැඩි. Right? Okay, let's move into the point B. Right? Now you can see the point A dash also and you can refer it here. Right? Before moving that, let's see. Point A dash in here, what you can see. Right? Point A dash, it says the domestic interest rate is higher than foreign interest rate. That's why we are getting positive value here. Right? Now, domestic interest rate is higher than foreign interest rate. And foreign currency at forward premium and foreign currency at forward premium. So what you can get the gain. So you are having foreign currency at even the domestic currency at domestic interest rate is high, but still you are getting the maximum benefit from foreign currency forward premium. What is the net gain? You still getting more benefit if you invest in other countries. Why? The foreign currency at forward premium. The net gain is 2 minus 1. You having still 1% gain if you invest into the foreign investment, even though domestic interest rate is higher at that point. Then me A dash එකකින් කියන්නේ මොකද්ද? Foreign domestic interest rate එක වැඩි foreign interest rate එකට වඩා. හැබැයි for foreign country currency එක තියෙන forward premium එක. ඒ වගේ අවස්ථාවකත් forward premium interest rate forward premium rate එක මෙතන interest difference එකට වඩා වැඩි නම් ඒත් මිනිස්සු ආයෝජනය කරනවා outflow වල capital outflow වල. Still you are getting net gain high. Okay, now what you can see from the point B. Point B, so interest rate difference, the foreign country interest rate is higher than domestic country interest rate by 1%, right? By 1%. That means foreign interest rate is higher than domestic interest rate by 1%. But foreign currency it at a forward discount by 2%. Right? Even though you are getting 1% interest difference in favor of foreign investment, your gain going to be diminished because of having 2% forward discount of foreign currency. Net gain getting minus 1%. සියයට එකක පොලිය ලාභය කැපෙනවා මෙතන 102ක forward discount rate එකකින්. එතකොට actually ඔයාට එන්නේ 1% gain එකක්. minus 1% gain එකක්. loss එකක් එන්නේ. Then what people can do? Even the foreign interest rate getting high interest rate, people try to invest into domestic country investment because now foreign currency at forward discount. That forward discount is more than what we gain as our interest difference, right? So this is what we call purchasing power parity, right? All these points that above and below the point of this color, this line, CIAP line, we can see in your right hand side, you can see capital outflow, right? In your left hand side, you can see capital inflow. Right? So that is what we call interest arbitrage. Right? Now all the points explain your what I am explaining to you, right? Point A dash, right? Now, if you look at this point A again, right? I'm taking your attention to the point A again. If you look at it, what you can see, now people try to invest into the foreign denominators. Why? The foreign interest rate is higher than domestic interest rate, and that interest rate difference is also higher than forward discount of foreign currency. Actually, this person getting net gain of 1%. 2% minus 1 mean 1% net gain, right? What happens if this process continue? As the arbitrage outflow continue, I am referring this point A, right? If arbitrage outflow continue, the transfer of fund from foreign investment reduce the interest difference in favor of foreign investment. Then the foreign investment demand getting high. As a result of that, foreign interest rate going up, foreign interest rate going down. Therefore, the interest rate difference in favor of foreign investment now getting decline, right? As well as increase the forward discount of foreign currency. Then now this foreign interest rate getting decreased, right? Now it's moving in here, and forward discount also getting increased, right? Forward discount increasing mean now it's getting in here, sorry, right? The increase of forward discount of foreign currency, that mean now your point, it's down this point A slowly reach into this place. Right? It's already reached into this place. right? So this CIAP line indicate that there is no arbitrage, interest arbitrage, profit or loss. Right? Now, as a result of investing in foreign denominators with the high interest rate of foreign investment, foreign interest rate, it reduce interest rate of foreign country, right? As well as it increase the forward discount of foreign currency. It increase the forward discount, right? Increase forward discount on the foreign currency. Then it reach the CIAP line. Make a keming line eකට කිට්ටු වෙනවා. Right? So all the points it's happening. All the points it's happening. So you can refer the note in here. At the point B, now you can see the transfer of fund to domestic investment reduce the interest difference in favor of domestic investment and decrease the forward discount on the foreign currency, and it reached the CIAP line. Right? So in your recommended textbook, please refer Exhibit 4.14, 4.15 and 4.16 for more explanation. Right? The only thing is in interest rate arbitrage, what we can see is when there is a difference in interest rate between two countries, there is an opportunity for investors to invest in capital outflow or capital inflow. So net gain they are receiving from capital outflow or net capital inflow depend on how far the domestic foreign currency or domestic currency getting forward discount or forward premium. Okay. Once the country has highest interest rate, now I'm going back to our initial discussion, right? Excuse. Now it says the country of the currency of country with the lower interest rate should be at the forward premium in terms of currency of the country with the high interest rate. This is our initial discussion. What we see, if country has a high interest rate, it has to be set off with forward discount of that currency in terms of other currency. Then you will reach out to this covered interest arbitrage parity. Right? මේ covered interest arbitrage parity එකෙන් actually exchange rate එක determine වෙන්නේ කොහොමද? high interest rate එකක් තියෙන රටක හැම වෙලේම exchange rate එක push කරනවා ඒ රටේ exchange rate එක එහෙම නැත්නම් ඒ රටේ currency එක forward discount එකක් බවට පත් කරන්න. How it become forward discount? Why we call forward discount? Because forward rate is at below than spot rate. අපි සාමාන්‍ය forward discount එකක් කියලා කියන්නේ ඒකනේ forward rate එක spot rate එකට වඩා අඩුවෙන් මේ ගණනය කරලා තියෙනකොට we call it as forward rate at a forward discount. Right? Then if a country have high interest rate, normally that currency should have a forward discount. Right? So that's the meaning of interest rate parity. Okay. Now allow me to go back to your session, and in here we discussing law of one price in terms of exchange rate, interest rate and inflation rates. Now, if you go back to your session again, you can now understand why we call the exchange rate determined based on interest rate and inflation rate. And all these things are depend on arbitrage experiences. Right? So arbitrage leads to have law of one price. So actually this law of one price reflects through our exchange rate. Okay, so purchasing power parity, it says when there are price differences because of having inflation rate, people try to dealing with low price with high price market. So at the end, it pressures to increase exchange rate in order to having law of one price. Right? When there are interest rate differences in investment market, right? People are dealing with interest rate arbitrage. Then at the end, it pressures to increase forward rate, or it pressures to having forward discount or forward premium on the exchange rate. At the end, it's coming to the law of one price we call purchasing power parity condition. Right? So that's the all about parity conditions. Okay, so just refer this explanation again regarding interest rate parity, and you will get more knowledge about the interest rate parity conditions. Okay, right. So end of the session. So this is the lesson for the day, right? So three statement for getting success. So this is coming from this quote taken from William Shakespeare. Know more than others, work more than others, but remember to expect less than others. Why? If you are expecting more, but if you are receiving less, you are getting disappointed. Okay? But if you are expecting less, but you are receiving more, then you're getting delighted. So delighted is better than disappointed. Therefore, always try to know better than others, work better than others, but expect less than others. So think about them, and hope you understand the parity condition of the session number 5 coming under the international finance subject, and refer this textbook and get additional notes and work out with the exercises I have given to you and enhance your knowledge. See you next time. Up to then, stay safe.